will take it over once you're done, Nikki.
Perfect. Nikki, go ahead.
All right. Well, happy 2025, everyone. We're excited for this year and what's going to be upcoming with the market and mortgage interest rates. This week specifically, we are going to get the jobs report. The jobs report tells us about job creations that and unemployment rates that influences the bond market and gives us kind of these fluctuations in mortgage interest rates. So right now they are predicting job creations between 140 to 160,000, depending on which report you look at. If we get slower job creations, that means that, or a lower number, that means that the bond market will be affected, will go down, and therefore mortgage interest rates will go down. The other factor playing this week is going to be the unemployment rate. Right now we are at 4.2%. It's expected to remain unchanged. If it does go up even by 0.1 or even 0.06 or 0.05, the mortgage interest rates will also benefit from that in the idea that the bond market will go down and therefore mortgage interest rates will go down. Right now, we are still in the high sixes, low sevens for conventional mortgage interest rates, but we are hoping to see some improvement in the next coming weeks. Of course, we have the big looming change in the administration on January 20th that although there isn't going to be this significant like, oh my gosh, we have new administration, interest rates just dropped. There will be some volatility and some fluctuation in the market. Not to the point where we're going to be like shouting out to people and being like, lock in your interest rate today. Things are crazy. But we are going to definitely see some fluctuations and keep an eye on that in the next coming weeks. I have noticed just from a mortgage application standpoint that we've seen quite a significant slowdown since the election results have came in. And that's just because people tend to sit on the fence. Not only as the new year turns around, there's plenty of people sitting on the fence, but also as people kind of do a wait and see to see what's going to happen with the market and going to happen with mortgage interest rates as this new administration turns over. So all in all, just things are pretty steady right now, and we're just kind of waiting and seeing for those jobs reports. The one thing I want to talk about today is mortgage insurance. There's a ton of misconceptions about mortgage insurance out there, and it's important for you guys as realtors to understand just the basics, I guess I would call it, about mortgage insurance, because this is probably the number one question that I get from buyers, especially lately when everyone's concerned about budget and what it looks like. I can give you some general guidelines. The actual cost of mortgage insurance and things like that can be pretty complicated or pretty intricate depending on the client and what their situation is. But from an overall standpoint, mortgage insurance on a conventional loan is required anytime the buyer does not put 20% down. So anything less than 20% down, including 19.99%, will require mortgage insurance on a conventional loan. On an FHA loan, mortgage insurance is required no matter what. You could put 60% down on an FHA loan and still be required to pay monthly mortgage insurance. For VA loans, there is no monthly mortgage insurance requirement. And for rural housing or USDA loans, there is a standard small amount of mortgage insurance that is required on those loans as well, no matter what. So from a more conventional standpoint, depending on how much you put in down payment, what your credit score is, and the length of the loan is going to determine your mortgage insurance. It also has something to do with debt to income ratios and income limits, depending on which program we're using for your mortgage insurance. So, in general, the more money you put down, the higher your credit score, the cheaper the mortgage insurance is going to be. On an FHA loan or a rural development loan, that mortgage insurance is the same factor no matter what. So if you are going to be putting down at least 3.5% on an FHA mortgage, you have the same mortgage insurance factor no matter what your credit score is. So if you qualify for an FHA loan, the only thing that can change your FHA monthly mortgage insurance would be if you lower the term, put 5% or more down. Those things kind of tend to say, okay, there's a slight little bump in like lessening of the mortgage insurance, but the amount of time it has to go on for your loan, it can vary. But in general, it's a good guideline to say FHA, always mortgage insurance in some way, shape, or form. Conventional, the more you put down, the higher your credit score, the lower the cost is for you monthly. Another important distinction is that the mortgage insurance on a conventional loan does eventually go away. It goes away when you reach 22% equity in the home, either by purchase price or by appraised value. So for example, if you have a client who put 10% down on a home a year ago, and all of it, and that home has appreciated another 10% in the last year. Now, whether that happens or not, I'm just using roundabout numbers. They are able to call their servicer and say, hey, my mortgage or my property has increased in value to the point where I do not need mortgage insurance anymore. What is the process for eliminating mortgage insurance sooner than it would naturally fall off the loan? Us as lenders, we are required to give a start date and an end date to mortgage insurance based on regularly amortizing payments. Obviously, that changes if the client makes more of a payment each month, et cetera, but we are required to give an end date for that mortgage insurance. We are also obligated to offer the client the option to purchase the entire mortgage insurance policy upfront. So in other words, instead of paying it in their monthly payment, they can pay for the entirety of the policy upfront. When this is advantageous for clients who are hitting top of debt to income ratios, but have some additional cash to put down on the property. It's advantageous if they know they're going to be in the property 5 years or longer. It's advantageous if the cost of that mortgage insurance can be refunded at any time within the loan policy. So those are just different things that we look at. It can become a bit complicated as to mortgage insurance, how it works, what the options are, et cetera, et cetera, et cetera, because that's just like any mortgage. With mortgage insurance, there's a plethora of options available to the client, and it's all based on how all those different factors of the loan come together. But for you as agents, it's important to know, just a couple of key rules. Conventional, less than 20% down. The more down, the cheaper the mortgage insurance. FHA, mortgage insurance no matter what. VA, no mortgage insurance, and rural housing or USDA has small mortgage insurance. So those are kind of the key highlights and high points. If your client does ask about, oh, I don't have 20% to put down, what are my options? Also, if you guys are with a client and they say, oh, I have my 20% to put down, so therefore my max purchase price is, let's say I have, $60,000 to put down, so my max purchase price is 300,000. It's great for you to encourage them to talk to their lender and say, okay, even though I have 60,000, if I purchase a home at 320, what is the actual cost of that mortgage insurance based on the additional down payment that I don't have to quite reach that 20%? Those are different things that we can talk through, and those are different things that can help a client purchase a home that might be a little bit higher than what they were expecting, but checks all those other boxes as to what they want, and can help in negotiating your negotiating power as well when you talk about seeing a home that's 320, that's maybe their dream home, and they really want to stay with that 20% down. So just different things to think about. A lot of clients are scared of mortgage insurance, but it doesn't have to be that scary. The actual cost of mortgage insurance and conventional loans has gone down over the last 2 to 3 years quite significantly because there's been competition in the market for different companies that provide mortgage insurance. The actual cost of that has gotten cheaper. It used to be quite expensive and used to take quite the toll on the client's mortgage as far as a monthly payment is concerned. Now it's just not so much. It's pretty rare that I see something that's going to cost a client over $100 a month from a mortgage insurance standpoint based on purchase price. So those are just things that we discuss and we talk through that overall cost, what it looks like to reduce that, when can you expect that mortgage insurance to go away, and what's a good strategy for it. But just for you guys as realtors, it's just important to know those basics.
Got it. Thanks so much. Real quick question that came to mind because I had a client that I just closed on FHA and this exact topic came up last year. Is it possible if there are a bunch of companies competing now that they can go back and do anything with an existing mortgage, or is it only going forward with all the
So
competition?
if you have a conventional mortgage, you
Mhm.
can call your servicer if there's enough equity to relieve the mortgage insurance. As far as getting a new cost to your mortgage insurance, that just doesn't, that doesn't happen unless you're refinancing and still need the mortgage insurance. So once it's set, it's set. The policy is set. But yeah, if they have an opportunity to refinance, then that mortgage insurance, if still needed, gets reset as well. So that's important to know.
Awesome. Awesome.
Yes.
Well, good. There's a good amount of people on this call, and this is a loaded topic, and you gave a lot of great information. So, what questions regarding this topic or anything else do you all have for Nikki?
So, hi everybody. My question is, how about the clients that are already in the house now and having that high home insurance? I mean, like I know the one option is to call few insurance company and compare. Is there any other help other than that for those kind of clients?
Yep, so that's a great question. So I want to make just a quick distinct difference between mortgage insurance and homeowners insurance. So mortgage insurance is an insurance policy that's taken out by the borrower for the benefit of them and the lender. It is an insurance policy that's designed to pay the balance of the mortgage if the borrower defaults or goes into foreclosure, so that they are not responsible for the balance of the mortgage, but the lender is also made whole, so that they don't have to take a loss either on the mortgage. That's mortgage insurance and what that's designed for. Homeowners insurance is going to cover the property and damage to the property by, claims, weather, fire, things of that nature, natural disaster. That's a whole separate kind of topic or a whole separate insurance policy. But to answer your homeowner's insurance policy correctly, yes, if you are seeing increases in your homeowner's insurance, which is happening a lot right now, as you get your escrow statement, and all escrow statements are going to be coming out here in the next 30 to 45 days, you can definitely talk to your current insurance agent, see if they can rerun a policy to lower that premium. And then there's a process to help you lower your payment with that. Or you can shop around to different agents and try to get a lower premium on your homeowner's insurance to help lower that monthly payment as well.
Thank you.
Yeah.
What other questions? Anyone else? This is great, great information.
That was good.
Uh,
And we remember we will keep this recording out on Angie's YouTube channel. So if you want to rewatch it, because it was a lot of information, or share it with anybody, you can do that.
Yes. Also, just to note, I've already posted a reel and a TikTok regarding mortgage insurance, and then an additional one regarding the Monday market update that's also on my YouTube channel. So if you guys want to share those, stitch them, whatever you need to do, they're already out there. My goal is to have those out there before our call every Monday this year. That's kind of like a mini goal of mine that I started, is to just say one for the actual market update and then one for our topic of education, etc. So those should be out and posted already.
That is awesome. That would be great. And if you want to just share, and make it easy on yourself, you can do that. And for those of you that are trying to do more video, go watch her video, take the points, and then create your own, either face forward or faceless, but about mortgage insurance, about these things that people are curious about, because these are the ways that you're going to get people to reply to you and say, hey, I have a question about that. Actually, I was wondering about that. And so I love that you lead by example, Nikki, and do that for us. And so it makes it easy for us to either share it, or as we start getting more bold, to create some of our own as well, which is fantastic.
Absolutely.
So thank you for that.
Absolutely.
Awesome. All right. So Angie, what did you have to add?
I just have to add that with some of the people on the call, or just in general, I did a goal setting workshop, I believe in November. And what often happens is we have the best intentions to get our business plans and our goals set for 2025 or the following year. So I just wanted to give a friendly reminder here today. Check in with yourself and really be honest. Are you doing it? Are you not doing it? If you're not, again, cut it, let it go. Do not beat yourself up about it. Let's start today. So reach out to me if you need help. I was on a couple calls last week helping agents kind of get ideas and solidify what this is going to really look like, because consistency equals success. You need to show up and be consistent over and over and over in your business. And find the pillars and the ways you're going to do that instead of going over here and trying this and that's not working. I'm going to go over here and try that. That's not working. And just ping ponging all over the place will just drive you mad and give you very little results. So I'm here. Look me up. I'm happy to help.
I love it.
Yeah.
So we are changing things up for the new year, Angie and I. Angie is always going to have her office hours. They're open to anybody. And she always talks about it and posts it here on this Monday call. Nikki is going to be joining us every Monday, doing the videos, putting them out there, leading by example, helping us share content and giving us the update every single Monday so that you can be equipped to do something with the information she shares. Consistency is critical. If you don't have information to share, you're not going to share anything. This gives you something to share every single week from a mortgage perspective as it relates to real estate, which is important because it's going to set you apart from a lot of the realtors out there. In addition to that, we want to make this a coaching and accountability call on a Monday when you start your week out. So as Nikki, finishes her portion, Angie has something that she's going to share. And now we're going to move into a time where you guys can share about your goals for the week, chat in the chat box, talk about challenges, share something that's going well, and really facilitate more collaboration and coaching. And Angie and I will be here from a coaching perspective to help you work through some of the things that are maybe challenging or to give you some new, fresh perspectives or do a strategy session or whatever it is. So 45 minutes on a Monday. The first 15 to 20 with Nikki, and then the rest of it with us to just grow our business is the goal. Instead of having disjointed calls at different times of the week when you guys are busy, this is what we're going to do for the new year. So we're very excited about it. So there will be more and more people joining. I'm going to be marketing this out to all of my database and all of the people that are with us every single week so people don't forget about it. And the more people that show up and share things, the more that we're all going to learn. So I'm excited for that. So Candace went first.